Hey traders, Steven here with the Traders Plan. It is Friday, October the 21st. I hadn't done a webinar in a couple weeks, so we're going to take some stock of the market and then what's going on. We got the election coming up. We're going to talk about that. We're going to talk about a lot of different things from oil to gold to emerging markets and different sectors, winners and losers, I think, that are going to come from the election. So it's going to be jam-packed. We're going to look at a ton of charts today. So grab your cup of coffee and let's get started. Going to start with the Nasdaq. Now, I drew this support and resistance line right here, and right now we're really just trading sideways. I'd say maybe we have a short-term correction in the Nasdaq or in the overall market. The market's down just a little bit, but look, since the Brexit, right, since this bar right here, look at, now this is an outperformance line of the S&P 500. So the Nasdaq has really gone straight up, meaning outperforming the S&P 500. That's really what you want to see in a bull market. You want to see the technology names leading. You want to see the Nasdaq leading because they're more aggressive growth type names. So I'd say that's definitely very positive. Really not going to get too worried on the Nasdaq, even though we did have some really, really ugly bars. You can see over in the thumbnail over here, you had a couple ugly bars. Some definitely distribution is coming in the market, and it's kind of looking like it's starting to round. But we are still in an uptrend, even though we've kind of been trading sideways for about 3 months. But really until this 49.70, 49.80 level, this clear support around 5,000 is broken on the Nasdaq. To me, this is a short to intermediate term correction. It's possible that we have a shakeout after the day after the election or for a week or two, which I'm going to show you what happened in 2012. But, you know, it's kind of interesting, and we're going to talk about shakeouts here in a little bit and how not to freak out and sell everything you have thinking the sky is going to fall, because you had the Brexit right here. So this was the day before Brexit, day after Brexit, and then so you had 2 days of just massive sell-off with the Brexit, and then the market turned around and just went higher immediately. And what that is telling me is that the market wanted to go higher all along. It was just really waiting for the Brexit to work itself out. And after you had that initial knee-jerk reaction, shaking everybody out, including myself, you know, I was guilty. I got shaken out of a couple things because I've seen waterfalls before, and I didn't want to be involved in this type of waterfall over here. But it just didn't happen. It shook everybody out, and then it turned around. So we're going to look at some things today. Let's look at the S&P 500. S&P 500 is not doing as well as the Nasdaq, mainly because the Nasdaq is full of technology. But, you know, I did draw this support resistant line that's kind of dominated by the trading range boxes that I also drew. But if you've ever read Nicholas Darvis, it's a phenomenal book, How I Made $2 Million in the Stock Market. I definitely recommend reading that. The guy talks about who made all the money back in the 50s, and he didn't have fancy charts back then. He actually wasn't even close to Wall Street or anything like that. But he talked about the best stocks that he saw that he picked. They traded in boxes, right? And I think this is because I'm a visual person. I have to see it. So you know the stocks and the overall stock market does this too, right? It goes up. It starts to trade in a box or a trading range, right? It starts to bounce around, hits resistance a couple times. Now there was a Brexit shakeout right here, but then it trended higher. It hit a wall, it fell into another box, and now is starting to trade within this box as well. So you can see when I say it's really starting to stair step its way higher. Now there is some clear support around 2120 on the S&P 500. It was clear resistance about 3 times right here, actually 5 if you want to go back to last year. So 2120 is a very important level on the S&P 500. If it breaks, I think we're going to have obviously a more intermediate correction. But right now it's holding, so I just have to consider really, I don't think the market is going to do anything. I think it's going to be rather boring until the election is over. So at least we can have some certainty which way, you know, and I don't know how the market's going to trade the election either. I would assume we'd either have a shakeout, probably. But right now we're just trading sideways. We're in a trading range, and until this 2120, which is very, very significant for the S&P 500 breaks, I'm not worried at all, because you can see right here, it hit it, found support. It really created a reversing candle. What day was that? On October the 13th, but closed above it. So I think we're still sitting just fine in the S&P 500. We're just going to kind of wait this out. I know we've really been in the trading range since mid-July, but I mean, it is what it is. The market doesn't go straight up. As a matter of fact, it probably most of your money is going to be made in 2 months out of the year anyways. I know you don't think of it like that, but that's the reality. You're going to have 2-3 fantastic months, and then the rest is going to be up, down, or sideways. I want to look at a chart that is very important right now, and that's the dollar. I think the dollar has a lot to do with what's going to go on with commodities, with emerging markets. So I felt that it was very important to really paint a picture on the dollar right now. So you had this massive run up for about a year, right? I mean, just, straight up $1.20 bull market. And then you've really had an ugly trading range for since early 2015, so about a year and a half. Now this is really sloppy, and this really isn't as big of a trading range as it really looks, because it's really only from 2650 to 24. I mean, you're looking at about a 10 to 11% trading range, so it's not as massive as some other charts I'm going to show you. But the dollar's really starting to strengthen. I typically am more of a horizontal trend line kind of guy, but they did break out of this downward trend. So the dollar is looking strong, and that's bad for commodities and emerging markets. However, emerging markets are moving up with it. And so it's kind of really hard to make sense of the dollar right now, because it's doing some weird things. But this is a very important, probably the most important ticker right now in the market. But if you look down here, what I did was I drew a correlation of the UUP, the dollar, to the emerging markets, EEM, over the last 200 periods. And you can see this zero line means it's not correlated at all. And anything below it means it's negatively correlated. So they have an inverse relationship. So the dollar has an inverse relationship with emerging markets, meaning if the dollar goes up, emerging markets should go down. And the same thing with gold. So since the dollar has an inverse relationship with a lot of the commodities, I compared it to the GLD. So when you have miners and gold and oil and emerging markets, all that have really performed strong this year, and now the dollar's starting to strengthen, it's really something we need to pay attention to. It's a divergence, I believe, in the market right now. So even though gold has pulled back quite a bit, emerging markets are still fairly strong. So is the dollar going to eventually kind of just keep trading sideways and emerging markets can continue higher? Or the other way around, is the dollar going to just completely break out and emerging markets and commodities completely break down? That I don't know, but let's look at some long-term charts and we'll see what you think. So this is commodities, okay? So this is the CRB, the Commodities Index. And you can see, now this is compared to the S&P 500. So since the commodities really peaked in 2000 and summer of 2008, you really have had just an underperformance with the S&P 500. Now, commodities to me is the same thing with emerging markets and the general stock market too. I'm really looking for long-term trends, and I want to make sure the long-term trend is up. And if you followed my webinar a couple months ago, I talked about the 10 and the 40-week crossover. It's just a really simple way to find out, am I in a long-term uptrend or am I in a long-term downtrend? Because if you're in a long-term uptrend, then you can buy the pullbacks and not get shaken out too much. But if you're in a long-term downtrend, you really just need to be careful and just move to the side and just stay away from that for the time being. So you can see when oil peaked back in 2008 when it got way crazy, along with gold and a lot of other things. And then right here, so you have the blue line, which is the 10-week, you have the red line, which is the 40-week, and then you have the death cross, right? So you would have, if you would have just followed this simple system, you would have got in about right here, you'd have gotten out right here, and then you would have gotten, so you would have avoided this complete waterfall. Now commodities are a little bit harder to play, but when they get in a long, why you want to pay attention to this kind of crossover, this kind of buy or sell signal, is because they can be in trends for a very long period of time, and they can go parabolic just like gold did. Gold went parabolic, or gold miners went parabolic earlier this year. So you want to really start to pay attention when the signal happens. So you have and then you have the golden cross, right? So you would have gotten in right here, gotten out right here. And then you had a little bit of whipsaw right here. Now, if you don't like whipsaw, get out of the stock market or just be a buy and hold investor, because if you don't like whipsaw, it's really just impossible. So you got a little whipsaw right here, but you'd have gotten back in right here, sold right here, okay? You got a little whipsaw right here. You'd had a little whipsaw right here, even though you'd have made some money. But then if you would have gotten out when this death cross happened, you would have gotten back in earlier this year, probably about May, right? So the golden cross, the point I'm trying to make is the golden cross has happened in the commodity market, which is going to be good for emerging markets. So I believe, based on this, now the dollar is acting weird, so I'm going to keep my eye on that, because a strong dollar could have an effect, will have an effect on emerging markets and commodity-based stocks. But the golden cross has happened, so now we are officially, air quote, in a long-term uptrend, right? The trend is up, so you want to trade with the trend. So as long as this trend is still up, maybe we get some whipsaw, maybe we don't. But it's important to pay attention, and I show you the correlation, show you, okay, so now this has happened. This is going to be very positive for emerging markets, because emerging markets, they're exporters, net exporters of, gold, oil, natural gas, beans, rice, all kinds of things that are commodity related. They are net exporters. So their economies and their stock markets are going to do very, very well when this happens. So you got the CRB, you got the UUP. Now let me show you a chart of oil, okay? Whoops, that's not the chart. That's an old chart. Okay, so now here's a chart of light crude. This is West Texas Intermediate. Not that Brent stuff. So you have West Texas Intermediate. You have obviously just a nasty, nasty downtrend. And the funny thing is, I talk about, that golden and cross, you'd have gotten out right up here. You'd have sold. Here, let's just put a number to it if we're going to get fancy. You would have sold probably about down here around 94 bucks if you were trading Brent crude. There was no cross that happened right here, and then you would have gotten back in. See, the cross happened up here at about 45. So you'd have sold at 95, you got back in at 45, you'd have avoided all this. And this is very important just because commodities, their cycles can be 2, 3, 10 years long, so you don't want to get involved in something like that. But then you had the golden cross happen. Let me get this inspect off. Oh, it's kind of acting funny. Okay, there you go. So then you have some major resistance around 51 bucks, right? It came down, right? It hit resistance at 51, went all the way down 26. Came up, right? Hit resistance at 51, came down. So this could be a reverse head and shoulder patterns, right? So you got the shoulder, the head, the shoulder, waiting for the breakout. Yesterday, oil got up to $52, so it tried to break out and then reverse lower. So yesterday, I'd say we had a failed breakout, but I'm really more focusing on the weekly charts. I don't really care too much about the daily charts on these long-term cycle type of commodities. So it did hit some resistance yesterday. So you have if it breaks out above 51, 52 and holds with conviction, I think we could easily go up right and settle right in the 63 to 65 area. If that's the case, commodity stocks, your oils, your XLEs, your oil and gas exploration, really the exploration stocks will do very, very well. Even if we have a downtrend, but oil is trending up, I think those stocks will hold up, and I think they will be moving up in the opposite direction of the market. So if you notice, I drew a little cup with handle here because I'm seeing patterns all over. So not only could this be considered a right shoulder, you can also kind of see a little cup, little handle, and it already broke out around 50 bucks. But there's some major resistance around 51. So if this breaks, oil gets to 52, you definitely need to be long some oil and gas exploration stocks because they're going to benefit very well. And if this happens, your emerging markets are going to benefit very well. So you can see there's a theme here. We're still focused on the dollar, but with the CRB, the oil looking like it's ready to break out, but we're going to have to wait and see. It might hit it, come back, consolidate again, and then give it a real go. So really kind of shake everybody out. But it's just very important to pay attention to this stuff right now. I want to show you, I did a webinar. Where is that chart? EEM. Give me just a second. I'm trying to find my long-term emerging markets chart. Okay. So emerging markets, so this is a monthly chart of EEM, okay? So I want to, and I just want to really highlight like how much emerging markets can move when you have a commodity cycle, or when just we're really firing on all cylinders. You can just invest in some ETFs and they can double and triple. It's really crazy. But you got back in 2000, 2003, 2004, really this was all in a trading range. And then just this ETF, now this is just an ETF, mostly of your BRIC countries, your China, your India, your Russia, Brazil, South Africa, things like that. This more than doubled, it tripled 215%. Now this is just from the breakout range. Now you could have bought it way down here, but this is just from the breakout range to the peak in 2008. The crazy thing about this is this ETF has not even hit an all-time high since 2008. It's really been trading sideways. So when something's been trading sideways for, I mean, what are we going on, 8 years, 9 years, something like that? Really since the beginning of 2008. When something's been trading sideways for that long, and then they really start to perk up, you need to pay attention, because when something's been in a trading range for a decade, and then all of a sudden it starts to move, you could be entering a major super cycle. When I say super cycle, I'm talking something that averages 20, 25% for 5, 7, 10, 15 years in a row, kind of like we did in the 80s and 90s. You had the U.S. stock market was in a super cycle. I mean, you need to really pay attention when these break out of their very long trading ranges. That's why I've really been beating you over the head with emerging markets really since late last year. And they've done very well. I was right on that. But that's why I'm showing you commodities, emerging markets, and all these things, because I think they could enter, if the stock market a year from now, let's say, enters a down period where you have like 2 years in a row where it's just not really doing very well, I believe this could be a huge place for long-term opportunity. So I'm not really looking this as a short-term trading, get 5% here, 7% here. I'm talking like doubles, triples, over a 2 to 5 year period. And I really think that'll happen. And I'm about to show you that it already has been happening. Okay, so you have this. So this is my sharp chart. I just want to show you now, this is the last 200 days. So you have the EEM, right? Just the regular emerging markets. So this is really the last year. And this is to show you that why emerging markets, it makes more sense not to just break it down by sector, but to break it down by industry. So think of the emerging markets as a sector, and think of Latin America as the industry, right? You want to break it down more, like what within emerging markets is really showing strength. So the Latin America has almost doubled what just the regular EEM has. And Brazil, just the ETF alone is up 97% in the last, or 98% in the last 200 trading days. That's nuts. That's the kind of outperform. And I really personally misplayed Brazil. I have made some money on it, and I sold it too early. But 98%. This is just a simple ETF in the last year. Peru 72%, global Argentina 42%, Mexico. Now I know we're looking at hindsight, but I've been talking about ILF, the iShares Latin America, for a very long time. So I know a lot of you have already gotten into it, but this could be the kind of next super cycle that I'm talking about. You talk about emerging markets, and then I get down even deeper and talk about Latin America, how you just could get massive growth potential over the long period. So Mexico has been a significant underperformance, but it's actually starting to perk up. and it popped up on my radar because on ETF sectors, I look at 3-month relative strength. So I really want to know what's happening over the last 3 months and what's showing strength. Right now, the Latin America's countries are showing a lot of strength. Mexico's starting to perk up. You got some Chile over here. Let me see if I can move this. I don't think I can. But anyway, so you have all these Latin American countries that are just smoking the regular emerging markets. And you have India and China, which is up about 20%. So they're kind of down here somewhere. They're underperforming, although they are starting to perk up. So I really, really think India, if you're looking at Asia, I think India with their demographics, just tons of millennials. They have the youngest population, exponential growth opportunity. I think, what China did in the 90s up to 2005, I think that's going to be India's up to bat next. And I think India will be huge. Now, when I'm talking about emerging markets, I'm talking about a wild ride. I'm not talking about just a simple, if you get scared at a 15 to 20% correction, the emerging markets probably isn't for you as a buy and hold strategy. But, this is the kind of stuff. So if I take this to the weekly chart and I say, okay, let me change some parameters here. So if you're looking how to play emerging markets, okay, that's... So if you're looking how to play emerging markets, for the long term, you could just use a simple golden cross, death cross rule, right? Death cross sell, golden cross buy. Simple as that. That way you won't get shaking out if you get a quick 15% correction, but it'll keep you in if we make a really, really nice move. Now, if you do get shaken out where you got a death cross and then it turns around and goes back up, you got to be willing to buy it back. Again, if you're not willing to get shaken out, if you're not willing to get whipsaw trading, it really isn't for you. So I just want to show you really some opportunities. I'm going to keep talking about emerging markets just because I think the opportunity is huge. Let's go to, I want to talk about the bank index for a minute. Now, these are, let me take a sip of coffee. Cup of coffee real quick. Gotta love it. So the bank index, now these are your regional banks, very interest rate sensitive type of stocks. I think as far as U.S. sector goes, there's huge opportunity in the banking index, mainly due to the rise of interest rate, right? That's nothing groundbreaking here, but I'm a visual person, so I want to show you since the Brexit how much the bank index has outperformed the S&P 500. And we've really been waiting on this for a while. I tried to get in some banks late last year, a little early, and then the market just rolled over in January, so I had to get out and just kind of be patient. But look at the uptrend, look at the outperformance, look at the consolidation. It looks right. It looks right to me. Now, you really need a confirmed breakout, but if we do raise interest rates, and good Lord, I've been thinking interest rates were going to raise since 2009. If we do raise interest rates at the end of the year and we start on a normal interest rate schedule, the banking U.S. stocks will do significantly, I believe, better and historically should outperform some other sectors. So I just wanted to show you some sectors I really like. Now, I do want to show you one. I'll get back into the sectors that are showing strength right now, the financials, the energies, and the technologies. But I do want to show you what I think could potentially be a loser from the election. Where is that? Biotech ETF. All right, so this is kind of disappointing. This is IBB, the iShares Biotech ETF. Now, this has been really kind of disappointing to me because you have a long-term uptrend, right? And then a long-term downtrend. So you have a break, you have a consolidation. This is a weekly chart, and then a breakout that failed, right? You have this nasty down bar. Now you can see, if we inspect this, you can see it might reverse today, so you might get a bounce. But this breakout failed, and I think this is really election year basis because you have a lot of the price gouging from the drug companies. You have a lot of really just, and I think the congressional grilling of some of these companies, and if the market is pricing in probably a Hillary type of election, and I'm not taking a position, I'm just saying that I think that'd be bad for biotechs. Now, that doesn't mean go off and sell everything right now, but I think that when you had a clear golden cross, right, a clear trend change, and then you had a failed breakout and now it's starting to turn lower, you need to pay attention. And if you did buy some biotech stocks down here, don't fall in love with them if you start to break even or the biotechs are really starting to break support. You probably need to get out of them and just have them sit on your watch list for a while, because it means they're not ready. Right? I have a couple biotech stocks that I love, but the sector is just acting weak. And 40 to 50% of a stock's overall performance is from its sector. So just kind of keep that in mind and don't fall in love with anything. And just biotechs, it's really disappointing, because if I go back and look at biotechs, made a phenomenal run. So if you would have done the 1040 crossover on the biotechs, you would have gotten in. Now, this is just a simple ETF. You've probably gotten in around 110 and gotten out around, so the crossover happened here. You probably would have gotten out around 309. So you'd have had a triple. That's just on a sector. So it's really crazy how much this biotech ETF has ran. But you have these just massive cycles, okay? So I want to talk about the election for a little bit, because I think it's obviously an important topic. It's on everybody's mind, and I want to look at some charts. What really happened? I want to go back to the current Nasdaq chart real quick, and I just want to show you what a shakeout can do. Now, you had the Brexit shakeout. Everybody was expecting Brexit. Boom. 2 day, just massive sell-off. There's blood in the streets, red everywhere, and then it just turned around and went to an uptrend. Well, that's kind of like what the election happened in 2012. And I have a chart of the S&P 500, and I want to show you that. So really, you can see, and I have a couple things going on, but really you can see, now this is S&P 500 in 2012. So it was kind of trending down, right? There was just not a lot going on in the overall market, right? Which is to be expected. So I wouldn't really expect a whole lot over the next several weeks. And then the day, I remember this is when Obama beat Mitt Romney. So the day after the election, I was a financial advisor. The day after the election, the market was down 2.37%. And then you got the skies falling, right? Chicken Little type stuff. So everyone was thinking the market's going to go into this massive bear market. We're all going to lose all our money, 2008 type of scenario. And really what happened is you had about a week and a half worth of selling, and then all of a sudden the market reversed, broke out, and then we went into one of the greatest bull markets in the last 15 years or so, since really, the late 90s. So 2013, the market was up, 35%, something like that. And this was at the end of 2012. So my point is, I wanted to show you the Nasdaq, what happened with the Brexit, right? Sold off and then turned back around and then just kind of went on a run. No one was expecting that. I wasn't expecting that. And then you get the 2012 election, and then the market, it sold off for a week, and then boom, it reversed and then just went on a massive bull market run. And if you were sitting on the sidelines, sitting in cash, you missed a phenomenal opportunity for growth. My point is, and the one reason I want to show you this is, no matter what the outcome of the election, just don't make an all or none decision. If the market's acting weak, slowly move to cash and slowly move back into cash. But don't let your emotions, whoever you feel should be elected or you want to be elected, don't let your emotions get the best of you. Because the reality is, in the stock market, I really don't care, about anything else, but I really just want the market to go up, right? Or if the market's going down, I want to make sure I'm in cash. So just don't let your emotions get the best of you. Shakeouts happen, and then can continue with the phenomenal run. So I just went and Googled stock market election years just to show you what the stock market has done during election years. So 2012, the stock market actually was up 16%. In 2008, we all know what happened there. That was kind of pre-Obama, so I'm not going to say that the market went down because of Obama. And then you had 2000, which that was obviously before Gore 2 because you had the tech bubble that peaked. So my point is you had two really bad times, but most election years, if you go back, you have to go back to 1940. 1940, if you exclude 2000, 2008 to get a negative year in the stock market in election years. So just, wow, and this goes all the way back to 1932. Boy, you got a lot of Roosevelt. And then 1928. So if you look at it, what you got, 1, 2, 3, 4 out of 1, let's just 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. There you go, 14, 15, 16, 17, 18, 19, 20, 21, 22. So you got 4 out of 22 years are election years that were down since 1928. That puts the odds in our favors, guys. I mean, you got to look at history. So, just pay attention to that, okay? Let's just go look at some sectors real quick to see where the money is flowing. And so we got just a little bit longer. Okay, so today consumer staples are up, technology is up, so that's defense. That's not great. Energy is down. Okay, so really the big three in my mind right now are technologies, financials, and energy. Those are the aggressive sectors that are really showing the most strength. So let's just look at the last week. So you got materials that have bounced, and that's kind of your golds. Utilities, not really what you want to see, but it's not, 0.71 in the last week, that's not crazy. So you got financial, technology, and energy. Really industrial, cyclicals, healthcare are all acting incredibly weak right now, especially healthcare. That's why I said be cautious about biotechs, because there's a lot of uncertainty around the healthcare system with the election. So maybe there's just, let's look at the last month. Okay, so the last month, 1 month, you have energy, financials, and technology. Those are the three. If you're bullish, that is where you probably should be focusing on most of your money. Energy, financials, and technology. Energy because the bottom in commodities potential that I showed you, and the bullish head and shoulder reversing pattern of oil. And UNG, which I didn't even talk about today, natural gas is looking like it's making a long-term trend change. And then you have the interest rate sectors, right? And then technology, which is just aggressive growth. That's where a lot of the earnings come from. So let's just kind of look at it real quick. Renewables, renewable energy equipment, really? What's in that? Canadian solar, okay, so a lot of solar. Look at the last month. Look at all the solar companies. So Canadian Solar, does any of them have a good scooter? Let's just kind of look at that real quick, just because it's at the top. Yeah, kind of looks like a long-term trend change, doesn't it? Let's look at the weekly chart because I'm a fan of it. It gets rid of a lot of the noise. Let's look at the last 5 years. Okay, so it's really been trending down. Canadian Soil has it made a massive run from $1 to $40 and came all the way down to 12. It's really still in a downtrend. So when you look at the weekly chart, this still looks ugly. You had the death cross a long time ago, probably way back here, and it really hasn't done anything yet. So I just be cautious. I wonder, let me kind of just go back. I wonder if I can look at the renewable. Yeah, see, it's in a pretty long-term downtrend. So might just be some junk buying. I'm not so excited about that. Oil, equipment, services, exploration. You got oil, equipment, and services. Let's just look at that chart for a minute. So if we look at a weekly chart, let me kind of go back here. Okay, so oil and equipment services, they were in a long-term downtrend, and now the golden cross happened. So trend change, it looks like it. And look at this massive volume bar, this reversal right here. It looks like it's trying to break out. It's failing in the short term. Could just take another test. If it takes another test down here, it's probably a good stab. Let's go see if we can find a stock or two in there. Let me just go back and kind of see at what is strong. Let me look at the strongest scooters. Actually, let me keep that percent change up. So you have Helix, Pioneer, Precision. So you got really a lot of names right here that are probably looking, oh, that's a penny stock. We don't want to. Let's get something that's a little bit stronger. Looking strong. NVR, you have really this trading range for about a year and a half, and then boom, the breakout. It's easing in. Probably going to find support the 20-day, or at least find support around 11 bucks. All right, so let's go to what was next? Financials. So you can see in the last month, boom, banks, insurance companies. They can only invest their cash in basically treasury bonds. So you have, and you can see, and this is a good sign right here. You can really see the REITs are at the bottom. They're just starting to get slaughtered, which is a defensive play. So I like what I'm seeing in the financials. Okay, let me be crystal clear. Don't just, if you're going to invest in a broad sector ETF, just understand you're going to have a lot of losers in that ETF. Why don't you break it down by industry and invest in a bank ETF instead of just a broad financial ETF, if that is what's strong, kind of like an IAT, okay? And then we have technology, mobile telecommunications, computer hardware, internet, so that's your Amazons, your Googles, your Facebooks, software, consumer electronics are getting slaughtered, so kind of like, Fitbit, which I still think is bottoming, and a lot of other stocks. They're just not doing well. Retail is not really doing well, but internet, mobile telecommunications, let's look at it, see what that's not that exciting. Sprint, T-Mobile. So you got some of the phone companies, a lot of that are doing well. I'm not really seeing the kinds of strength in this that I was seeing in a lot of the oil stocks. So it's just something to pay attention to. Internet, let's see what's been doing good in the last month. GoDaddy, just some NetEase is a very, very strong stock. 10-cent Alphabet. So you can see some stocks towards the top. You got a lot that aren't doing very well too. Most Chinese names down there. So I really hope this was helpful, and really the key takeaway is, I focus on commodities, focus on the dollar. If we're going to have a cycle shift where eventually U.S. stocks will fall out of favor and commodity-driven stocks will, I want you to place yourself appropriately with the strongest emerging markets. Commodities are definitely harder to play. I'm not a fan of playing individual commodities, except for some of my clients are in UNG and they're doing very well. And I recommended that. I'm not saying that's a recommendation for you, but I'm just saying I think sometimes they're a little bit harder to play. Individual commodities are not a set it and forget it. They don't quite trade like stocks, so you just have to be cautious. But if you're looking for long-term plays, I think some of the emerging markets I was talking about, and make sure you don't get shaken out, and just be patient with the election results. Don't make all or none decisions. I hope this was helpful. Let me know if you have any questions.